Hey folks, we now want to take a look at a company that might be going public. And if they are, what are the prohibited services? Services that may or may not have been allowed when they were private and we could still be independent and audit them, versus now there's a taboo. We can't provide these services and still be considered independent and perform the audit of them. Let's take a look at what the PCAOB has said regarding prohibited services. Let's begin. Well, Sally from Sally's Dog Walking Service is considering taking her company public. As part of her research regarding the topic, she reaches out to Donna Partner from Becker CPA to find out what impact would this have on her annual audit. Donna Partner writes back the following email. So we want to see what it is. And here's what we're going to talk about. It says, there are a number of differences that you would need to consider. And she's, of course, very excited about the possibility. Only registered firms can audit an SEC issuer. Unfortunately, our firm is not registered with the PCAOB. We focus in on smaller private entities. However, we have connections with firms that are registered and would be happy to help find the right auditor should you decide to make the move. The second one, bookkeeping is prohibited service under the SEC rules. We currently provide preparation services for you, including assisting with your note disclosures. Notice the SEC would prohibit a PCAOB auditor from providing this type of service. So you would need to ensure someone on your team could handle the transition and responsibility. Now, by the way, before we read on, remember, not only bookkeeping would be prohibited, but valuation work, doing the internal audit work for that client, providing expert services unrelated to the audit, doing tax prep for the officers of the company, working on contingent fee services would all be prohibited. A couple of things would be allowed. You would still be allowed to do the tax returns for the company, provided they were pre-approved by the audit committee. And of course, as we saw in the last module, you are allowed to prepare a comfort letter if necessary. Let's go back to this material. The audit partners must rotate every 5 years. Since you engaged us 15 years ago, I have been the partner in charge on your audit. The SEC rules would require that your new audit firm rotate the partner in charge of your audit every 5 years. There are pros and cons to this, but you would want to understand any potential firm's methodology for ensuring a proper transition. And finally, the audit committees are responsible for engaging the external auditors. Currently, you have a board of directors, but not an audit committee. Your board would need to create an independent audit committee, and they would have the responsibility of engaging the external auditor. The CEO and CFO would not be the person managing the relationship. Obviously, these are things that you need to consider as you go forward. I'd be happy to speak with you about the impact of our relationship. Please let me know if you have any other questions. Hopefully, through this little exercise, you've gotten a better idea of the prohibited services once the client is public if you want to stay the auditors.